Yeah. This is another interesting article which talks about some of the ways you should identify the warnings in the accounting statement. Probably cooking up exercises. The cash flow statement we have seen in the earlier one, but the same thing could happen both with the balance sheet as well as P&L statement. Either the companies may look at showing higher net income or lower net income. Higher net income to satisfy their shareholders, lower net income if they want to save on taxes. So there are different motivations for different numbers, right? So what we are looking at here is, what first thing is, why do companies report more or less in terms of net income? More is one to meet analyst expectations. The analysts, most of them may have given a buy signal on this security. Suddenly, if the company's performance goes down, the analysts will put a very big negative mark on the functioning of that company, which is what has happened in the case of Infosys in the last 2-3 quarters. Analysts are putting very heavy stress on the forward movements of Infosys. Infosys, though it is doing good, but not up to the expectations of the analysts. The day on which their results are getting announced, their stock price is dropping by 10%. This has happened for the last 3 quarters. Almost 10% drop in one single day. At least 7 to 8% minimum on any single day. On that day only, the day on which the results are announced. Because then, though it is doing well, the analysts are putting even more bigger bets. Now, Infosys, from all possibilities, it will not cook up its financial statements. So, whatever is the actual numbers, they are publishing their actual numbers. But it is not satisfying the analyst requirement. So, immediately that is getting reflected in the prices going down. Suddenly, only for the day or two, the prices will drop down suddenly. And of course, slowly over a period, again they are picking up. So, the companies will try to report over especially than what their actual performance is to meet the analyst expectation. One, to meet with the debt covenants, because as a part of your indenture, you must have clearly specified that I will maintain this ratio at this number. Right? So, to make sure that those things are happening and to be in the good books of your lenders, you will try to show a higher number. And 3, most of the senior management, their salaries are tied with the company's profitability. So, even from that standpoint, sometimes you cook up the numbers. Right? Again, cook up is 2 aspects. One is a real fraud, 2 is a manipulation. Real fraud is one aspect, which is probably, there may be difference, there may not be a difference. It's a very thin line of difference between the two. I am manipulating is within the scope I am trying to play around. Fraud is just going beyond the scope and probably adjusting the numbers. Beyond the limits, beyond the guidebook, I am going and making the modifications. Okay, sometimes I do the understatement of the earnings. One, to get a trade relief from my vendors. Just give me a few more extension to the accounts payable, or some kind of benefits from the government. This year we did not do well, so probably let this subsidy be extended to us also. Right? Just like on an individual note, people show that they belong to less than poverty level just to get Indirama houses. So those kind of manipulations can very well be done even at a company's level also. So renegotiating with the creditors. This year I cannot pay. Probably will, just like okay, in Kingfisher case the scenario is more different. But in some cases I can show that the profitability is bad exclusively to renegotiate some kind of terms and conditions with my vendors, or even with labor union contracts. Will not increase the salary this year. You see the profitability is very bad. So you work for this one more year, next year will increase your salaries. So probably those for that kind of scenarios, they can show a negative. And even this is a very important aspect. Save earnings to report in a future period. This year I'll show a slightly poor profit, net income. Suddenly next year I'll show a very high income. Whatever the actual income here, I'll show less than the actual here. Next year probably assume that I'll show only the actual. It shows they have jumped extraordinarily. From nowhere I became a... See, probably people will forget that I have gone down from somewhere. That's the aspect at that point. But this company bounced back by this much percentage. Probably the way the media, the analysts, everything come out on that, this company bounced back extraordinarily. So probably the future projections will go extremely high. Just to bring out that kind of hype about the performance of the company, companies try to understate their earnings this period. Next period they will show a higher number, and percentage growth would be a phenomenal. The company has grown by 200% in its profit compared to last year, which means probably there is some sudden turnaround in the performance of the company, wherein in reality nothing is there. But they try to create these kind of things so that the analysts and other stakeholders, they try to increase the value of the company. Right? Now the more important aspect to look at is looking at the quality of the earnings. See, earning is net income. What is the quality of that? How trustable, how reliable is that net income? So, most of the times when companies select different accounting policies which are used for misrepresenting, so wherever aggressive is required, they show conservative. Wherever conservative is required, they show aggressive. Right? Especially in revenues, probably they show high revenues. Wherever they have to show expenses, they'll show very low expenses. Based on that, they'll show very high profitabilities. But those kind of earnings are not sustainable. So the estimates which are being used also, sometimes they use aggressive estimates, unrealistic estimates, because so probably they may say, though 1% of the goods are coming back every year, they'll say only 0.25% of the goods are coming back every year, and based on that they will compute the net income or profitability. So it will show a higher number. So using any aggressive estimates, right, which are much different from the industry average, and you are structuring the transactions in such a way that it will show higher value this year. Let's say simple, if I am making an annual report, I have done some sale in on April 2nd, right? A big sale on April 2nd. Logically, April 2nd of this year. It will go into the financial statement ending next year, because April to March is the financial year. It has to go into the financial statements ending next year. What they simply show is, they'll show that sale as done on 30th March. So it will come in this year. 1 year earlier I am showing my profit. When I am looking at annual report, 1 year earlier I am showing my profit. So probably the valuation will simply go up. So those kind of structuring of the transaction expense. If I have incurred on 30th March a huge expense, I'll show as if it has been incurred on 2nd April. Expense will come somewhere next year. So there are different ways. Of course, I am showing it as a very simple picture, but there are some complications involved in that, right? But specialists can very well do that kind of manipulations, right? Probably if you understand the way the calculations are being done, you can very well manipulate the numbers. So these are some of the things. So we are structuring the transaction in such a way that this year I'll show, if this year I want to show high profits, I'll do probably realizing the earnings earlier than when they have to be realized, or expenses the next year. These kind of manipulations I can very well do, and even I exploit the intent of an accounting standard. If the accounting standard is allowing me to go both with LIFO as well as FIFO, I'll see which one is really profiting me, and based on that I'll I'll choose a LIFO or a FIFO method. So last year I might have chosen LIFO, this year I am shifting to FIFO because I want to get some advantage out of the accounting method. So probably I will convince my auditor also accordingly. But I'm doing these numbers within the scope. I'm not putting false numbers, but I'm exploiting the accounting standard, the flexibility which the accounting standard has typically given. This is what we typically call as fraud triangle, wherein anyone who is doing the fraud, I mean, this is a very generic phenomenon, right? The first thing is there is an incentive or a pressure, under pressure, anything. The fine motive is, okay, if you do this fraud, you will get an incentive. That's one type which instigate a person to do a fraud. Two is pressure. If you don't do this, you are fined. So probably most of the frauds that are happening in the country also, they'll go with either one of them, either of these two, or probably in some cases both also. So you can very well elaborate. It's a very common phenomenon where you can look at threat to the firm's financial stability. So you are forced to make a change. You are right. If financial stability of the company goes, probably analysts rates it bad, you will lose your job. There could be a big change from there. So you have ultimate pressure to increase the numbers, or the personal net worth or third parties, they are putting pressure. Analysts, they put pressure on the company sometimes. You manipulate the number, otherwise we are because analysts are someone who have invested heavily in the company. For them, they are losing heavily. The moment stock price falls, their worth will fall down. So they will try to put extra pressure on the company. Instead of performing well, they will try to manipulate more. Probably the Satyam saga is exactly the same scenario. Every quarter they had to show a higher result because of so many additional pressures apart from the personal greed. There are so many external pressures in terms of maintaining the stock price at that level. So which has resulted in manipulating exercise year after year. Right? Probably what could have happened is if the manipulations are done 2-3 years, and after that if the real profitability has come up, all this could have got neutralized off. But the profitability is coming only to a certain extent, but at the same time they had to show that much high values to keep themselves at par with the competition and various other stuff, which has resulted in that number piling up and the fraud breaking out. So external pressures, management, employees and all. So based on that, they work on opportunities. They wait out for the opportunities. Once there is an incentive structure or a pressure, and once that is there, they look out for opportunities where there is a weak control system. Right? In probably a minister who is ready to sign all the fraud which I am going to do. They are the opportunities. Or probably some bribe taking officer is there. So approach through that officer. I am trying to find out the opportunities where that fraud can be done. So from a management standpoint, if my top bosses are simply signing, okay, you do the report, I'll simply sign it off. So if those kind of things are there without too much of scrutiny and all, I'll say I'll go via this manager, he'll simply sign my document and it's over. So things get, so I'll try to wait for opportunities where the controls are not there, where complex reporting structure is there. I have to report to 2 bosses. I can very well manipulate the expenses or whatever, I can very well manipulate. All these kind of things are opportunities to do the fraud. And the third important aspect is rationalization. Only if these three are there, a person will do a fraud. Right? First of all, without any incentive or pressure, no one will take the risk, because doing a fraud is a risk. Right? And then if he has to find a right opportunity, and he has to rationalize, like our politicians. They'll never say we did not do wrong. They'll only say others also have done the same mistake. When others have done it, why not I? Or probably what I am doing is not wrong. Because that's a very common phenomenon. That's the typical rationalization. Unless you rationalize yourself in your attitude, probably you try to speak negative of the others rather than trying to bring out or trying to address your fraud. So which are typical rationalizations which you see at a lot of places, even in organizations? They say, yeah, this kind of accounting is commonly done by everyone. Instead of saying this is a fraud and we have manipulated it, it becomes a normal practice. That is where sometimes, when you are really taking up jobs, these kind of practical things you have to understand. It may not go exactly with the books, but some kind of these numbers are very much possible, right? Either because of pressure or whatever. Now, as an auditor, if he is okay with that, things are moving forward much faster. And auditors also, they can rationalize. Oh, this is something which we are observing with every company, so we are not identifying it as a deviation anymore. But in the books, it is a deviation. But probably the auditors will say, this is a very minor thing every company is following. That minor slowly becomes major. That's a typical way any kind of fraud gets created. And so this is a typical fraud triangle, again used from a psychology standpoint rather than a finance, but it can be applied to the financial world even. Right? One, any intensive pressure or incentives are there. So just to that, I wait for the right opportunity, and even after I do the fraud, I am very much cool and calm, because I know how to show it up in my attitude, as well as how do I rationalize that kind of fraud. So common warning signs from an analyst standpoint, what all he has to see. If the company is doing aggressive revenue recognition, one example I have given, April 2nd, bring it to March 30th. So they are accelerating the revenue recognition. That's one way. Two, different growth rates per operating cash flows and earnings. Because you are talking of reasonable estimates. Right? Or when you typically look at net income, they are showing that it has grown by 20% compared to last quarter. But cash flow from operations has fallen. Then I can sense some kind of cooking. Net income has gone up drastically. Because in net income, I can show more sales or less expense. Net income can go up. But cash is a real entity. So cash flow from operations, if it is still fallen down or gone up only by a limited extent, I sense some cooking. Again, I am not saying it's fully cooked, but warning signal. Explore more. Detect. Right? Be critical on that number and try to investigate a little bit more on that. There's no need that it is a fraud, but at least some pointer for you to evaluate, investigate. Abnormal comparative sales growth. When the whole competitors have grown at 5% in their sales, your company showed 30% growth in sales, which is very much possible. But again, it's a pointer. Right? Reality could very much be possible. All competitors grew at 5%, but you grow at 30%. Probably that you could treat it as your core competence. But yes, before you conclude that it is the core competence of the company, you investigate on any cooking up that has been done. As an auditor, at least I can look at their journals, ledgers, entries and all these things before I take some kind of any conclusion on that. Then similarly, abnormal inventory growth compared to sales. I did not take up the sales drastically, but the inventory has gone up. What does it indicate to me? If the inventory is going up, my assets are going up on one side. Cost of goods sold is coming down. Cost of goods sold is coming down. My net profit is going up. Just with change in inventory method, my inventory can go up. Inventory is going up means cost of goods sold will come down because the total is adjusted between cost of goods sold and inventory. Inventory gone up, cost of goods sold coming down, gross profit going up, all other profits are going up. So your net profit, finally, net income is going up drastically. So companies can play around with the inventories, changing the inventory valuation methods and all. They can very well play around. And non-operating income, they'll show it as operating income. So your operating profit will be much higher. Cash flow from operations will be much higher. There's nothing. I mean, what the headings they are changing. Are any gains, extraordinary gains? They'll show it as normal operations gains, which will show that operating profit of the company is heavy and operating cash flow is also heavy. The moment I show it as non-operating, probably cash flow wise it will go as cash flow from investing or investing, which I am least bothered. As analyst is more bothered about CFO. So CFO, to come out as higher CFO, they'll do these kind of manipulations. Same thing they can work on expenses. Delay the expense recognition. Whatever is the expense of this period, they'll put it to next period. So this period the profits will be much higher. Right? And they can do the same process year over year. Still that is possible. Let's say as the company is growing, every quarter the expenses will grow. But instead of taking the expenses of this 4 quarters, revenues I will take for this 4 quarters, expenses I will take for the last 4 quarters. Obviously it shows a continuously growing profit. Right, which will showcase good profits for the company regularly. So I mean, to make it more sophisticated, I will do it right from the ledger data entry levels itself, if I want to manipulate with the auditors. Right, then normal expenses I'll classify them as extraordinary expenses. See, extraordinary income I'll classify as operating income. Operating expenses I'll classify as extraordinary or non-recurring kind of expenses, so that it will not affect my operating profit or it will not affect my cash flow from operation. These are some of the regular manipulations which the companies will do. Probably they are still within the scope, but from an analyst standpoint, the ratings of the company will grow up drastically. If the analyst does not look at these things in seriousness, and if it's only a template that drives the value of the company, now the template will show a high value because these numbers are showing more and more profitable for the company. So the template will show a good number, because see, an analyst cannot sit and see each and every item. So if these manipulated items are still going away, what you can very well see is the company's value will get an upward valuation. But probably even if a template is getting developed, it has to take into account all these scenarios. Only then a good value for the company can be provided. Right? Yeah. Some other warning signs. Okay. LIFO liquidation is a very important aspect. See, when I am saying LIFO, I am showing the last few things as a part of my cost of goods sold, and the very older items as a part of inventory. Right? Now assume that my inventory is significant enough with the old items. Next year I have done some sales, but I did not do any raw material purchase. I've used up my existing inventory. The existing inventory will be shown at a very low cost. Whereas in this year, the cost of that raw materials would have gone up drastically. But my inventory is showing very less value. I'm removing all that inventory and showing it in my cost of goods sold because I did not buy any raw materials for this period. Suddenly for this year I'll show a very high gross profit because cost of goods sold is a very small number because it is reflecting the cost 2 years back. 2 years back cost is what it is reflecting, whereas the sales are reflecting the current selling price. So obviously my gross profits and net profits, everything will be much higher. So that way this year, that is what I call as LIFO liquidation. Because of LIFO, the inventory is having a very low value. What I'll do is once it has become significant, I'll liquidate that entire inventory. So that entire inventory will come into my cost of goods sold, which will be a very small value compared to the sale. Suddenly it looks as if the company has performed drastically well. 2, they have maintained extraordinary inventory management. Lot of positives will come out in 1 year. But the problem is next year they cannot do that because inventory is over. So it can be done only once in a while, but analysts have to be careful with that. And abnormal comparative margin ratios. So profit, net income, competitors having a 12% profit margin, but this company is having 25% margin. May be possible, but just needs to be investigated. Because they might have booked some heavy sales, because of which they are showing more profitability compared to their competitors. Or when all the competitors have shown negative profits, this guy is showing very high positive profits. Could be an exception, but again, better to investigate. Aggressive assumptions, estimates, anything aggressive, it's better. And year-end surprises. Suddenly in the 4th quarter, the revenue goes up. 3 quarters, the revenues are much, much lesser. Suddenly in the 4th quarter, you see some big sale is booked. Any big numbers towards the end of the year, they could be very well looked at as cook-ups itself. Probably something of the next month also they are pulling it into this month. Or just with a oral order which has been agreed upon, they are showing as if the deal is over. These kind of things have to be very much looked at. And equity method investment with little or no cash flow. I am buying out something just by giving some of my shares. See, if I have to buy, let's say, a big asset, one way of purchase is I'll pay cash. If I pay cash, my cash flow will go down. Instead of paying cash, I'll say I'll give you 10 shares of my company. Shares will go up, but cash will be remaining there itself. These are some of the things you have to be very careful of. Why did the number of shares go up? Or did the shares go up just to buy some asset? If that's the case, probably it's better to revert that transaction. Because we are not bothered about meeting accounting standards or something. For us, we are bothered about what should be invested in this company share. So better revert that equity purchase. See if it has been purchased with cash, what is the impact. To make sure that you are comparing companies on an equality basis. Right? And aggressive use of off-balance sheet financing, especially your leases. If you see, if instead of treating something as a financing lease, they'll treat it as operating lease. So no entry in the balance sheet, only P&L statement. Right? So if it is entered in the balance sheet, your assets, liabilities, everything will go up. Your ROA kind of ratios will come down. To avoid that, companies don't want to make their balance sheet very heavy. They want to lighten their balance sheet, so they remove some of the transactions from the balance sheet altogether. They'll try to treat them, though it's a financing lease, they'll treat it as an operating lease. right? Though it is a financing expense, they'll treat it as an operating expense, just to make sure that they'll make their balance sheet much lighter. So even those kind of things have to be looked at as warning signs from the performance of the company standpoint.